For a while, it looked like Sam Bankman-Fried had cracked the code. In just a few years, he turned a niche crypto exchange into a global powerhouse. FTX soared to a $32 billion valuation, backed by A-list celebrities, major venture capital firms, and lawmakers who believed he could help shape the future of finance. Sam wasn't just rich, he was revered. He played the part perfectly. Young, scruffy, brilliant. He talked about ethics, gave to charity, and claimed he'd donate most of his fortune. He wasn't in it for the money, he said. He was trying to make the world better. People believed him. But behind the scenes, the math didn't add up. When FTX collapsed almost overnight, it wasn't just a company going under. It was an $8 billion trust fall. Customers were locked out of their accounts. Investors were blindsided. Regulators scrambled. And at the center of it all, Sam. The trial pulled back the curtain. Fraud, misused funds, and a tangled web of deception, all traced back to him. He's no longer the face of innovation. He's the cautionary tale of how fast it can all fall apart. So, how did no one see it coming? Why did everyone, from Wall Street to Washington, look the other way? And how did a guy promising to save crypto end up nearly destroying it? To understand how it all fell apart, you have to start with how it began. Every tech giant starts somewhere. For Sam, it was a cramped apartment near Berkeley. He wasn't just smart, he was raised in it. The son of 2 Stanford law professors, he was fast-tracked through MIT, then landed at Jane Street, one of the most elite trading firms in the world. That's where he learned to play the game, move fast, bet big, and find hidden edges no one else could see. By 2017, crypto caught his eye. One thing stood out. Bitcoin was trading higher in Asia than in the US. It looked like free money. Buy low here, sell high there. But moving money across borders was slow and heavily regulated. Most people couldn't make it work. Sam did. With help from a Japanese grad student and a bank that looked the other way, he set up accounts in both regions and traded simultaneously. Buying Bitcoin in the US, selling it in Japan, pocketing the difference. The strategy was so effective, it closed the price gap entirely. It cemented his reputation as a prodigy who could outsmart the system. That early success gave Sam momentum. He saw that existing crypto platforms were unreliable or downright shady, so he built his own. FTX launched with one clear mission: give traders a platform that actually worked. It exploded. Within months, FTX was handling billions in trading volume. By the time the public caught on, it was already a dominant force. By 2021, the company was making over $1 billion a year, with fewer than 25 employees. Sam knew this was his moment. He pitched big-name investors and didn't bother playing the part. At a Sequoia Capital meeting, he explained his vision to make FTX the backbone of global finance, while literally playing a video game on the call. They gave him $1 billion anyway. The money poured in. So did the headlines. Celebrities jumped on board. Super Bowl ads, political donations, A-list events. FTX was everywhere. Tom Brady, Steph Curry, Bill Clinton, even Katy Perry appeared at FTX-sponsored gatherings. Sam bought a $30 million penthouse in the Bahamas, flew private, threw lavish parties, and brushed shoulders with world leaders. At one point, he even considered joining Elon Musk's bid to buy Twitter. By then, Sam wasn't just another crypto founder. He was being pitched as the guy who could reinvent finance. He had the brains, the funding, and the narrative people wanted to believe. What set him apart was how he talked about money. He claimed he didn't want it for himself. He said he planned to give most of it away. The idea of getting rich only to give it all back became central to his brand. He kept repeating the same message. Wealth was a means to an end, not the goal. In a space full of people chasing the next cash out, Sam positioned himself as something different, and people bought it. Even as the crypto markets began to unravel in mid-2022, Sam leaned into the role everyone expected him to play. He offered bailouts to failing firms, warned against shady players, and spoke about caution and responsibility. While others panicked, he stayed calm, and that calm became part of his brand. By then, he was being called crypto's moral compass. Some believed he might end up both the richest man in history and the most generous. Then came November 8th, 2022. Sam dropped the bombshell. FTX was short $8 billion. A rescue deal with Binance was supposedly in motion, but it collapsed almost instantly. Binance backed out after looking at FTX's books. The hole was too big. Within 24 hours, FTX filed for bankruptcy. Sam stepped down as CEO. The illusion shattered. The man seen as crypto's last grown-up had been propping up something much shakier than anyone knew. As investigators began to dig, the real story surfaced. A hidden link between FTX and Alameda Research, both run by Sam, both operating in secret under the same roof. The deeper they looked, the stranger it got. In early 2021, Alameda poured $40 million into a new crypto project called Oxygen. It had no real team, no updates, and rushed out a token in weeks. FTX listed it anyway. On day one, $176 million worth of tokens were traded, before crashing 99%. But this wasn't an accident. It was part of a broader pattern. FTX regularly listed tokens tied to insiders, released only a tiny portion for public trading, and then let Alameda drive up the price through small volume trades. These weren't just tokens, they were Sam coins, and they made Alameda's balance sheet look much bigger than it really was. Inside the company, people who questioned the numbers were pushed aside, but outside, cracks were beginning to show. A leaked balance sheet shared with CoinDesk revealed the truth. FTX wasn't holding customer funds one-to-one. Instead, billions had been moved into risky, illiquid assets. Worst of all, Alameda's largest asset was FTT, the token FTX had created, and it was being used as collateral to borrow more money. It was a system built on its own made-up numbers, and underneath it all, there was nothing. What most people didn't realize was that by then, the damage was already done. Months earlier, the crypto world had been rocked by a series of implosions. Luna, Celsius, Voyager, Three Arrows, and Alameda had exposure to all of them. The fund took massive hits. On the surface, Sam kept his cool. He offered bailouts to struggling firms, gave interviews, and projected strength. But behind the scenes, the pressure was mounting. Desperate to plug the hole, he reportedly began siphoning customer deposits from FTX into Alameda, nearly $10 billion in total. When investors asked for proper financials, they got vague bullet points sent over Telegram. There were no audits, no oversight, just trust. And that trust was being drained, along with the money. It's one thing for a hedge fund to collapse, but it's another to cover your losses by secretly taking billions from the users who believed in you. Maybe Sam thought he could fix it, buy time, steady the market, and clean up the mess before anyone noticed. But in November, that illusion came crashing down. Binance, FTX's biggest rival and an early investor, caught wind of just how fragile Sam's empire really was. Whispers were already spreading, but when Binance publicly announced it would dump over $500 million in FTT tokens, the message was clear: FTX wasn't safe. The price of FTT plummeted. FTX's balance sheet took a direct hit, and then the panic set in. Withdrawals surged. Customers rushed to pull their money. Billions were requested within hours. FTX couldn't keep up. As pressure mounted, Sam tried to steady the ship. He posted on social media, insisting that everything was fine and funds were safe. One day later, he admitted they weren't. Despite everything, the missing billions, the fake balance sheets, the broken trust, Sam Bankman-Fried went on a media tour, claiming he never meant to hurt anyone. But no amount of interviews could erase what had happened. On March 28, 2024, he was sentenced to 25 years in prison for one of the largest financial frauds in history. His parents got mansions, his friends got paid, his users got wiped out, and the crypto world was left shaken to its core. Because this wasn't just about one man or one company. It was about the illusion of accountability in an unregulated industry. It was about how charisma can become a shield, and how, when no one asks hard questions, the damage spreads further than anyone expects. Sam once said he wanted to save the world. Instead, he nearly took an entire industry down with him.